I'm Preeti Vasishtha, Editor-in-Chief of Contingencies Magazine, and I will be hosting this episode of the Actuary Voices podcast. I'm excited to talk to Selma Hepp, Chief Economist at Cotality Insurance. Selma, welcome.
Thank you so much for having me, Preeti.
So I had the pleasure of hearing you speak on the economy, housing trends, AI investments at the Cotality annual conference earlier this year, which was really lovely. So before I get into those topics, let's talk about what led you to becoming the chief economist at Cotality. If you could tell us about your background and your role, that'll be great.
Sure. Yeah. So I've been at Cotality since 2020. I always like to mention that my first day was March 17th, which was the day of the shutdown. So, I started off when everything was going in turmoil, and particularly in the housing market. So it was a very interesting time to start. It was CoreLogic at the time. Now it's Cotality. But I have been working as a housing economist for a number of years. I worked previously as a chief economist for a company called Pacific Union. It was a real estate brokerage in the Bay Area. Well, during my time, it was bought by Compass Real Estate. It's now a big brokerage in the U.S. I was a chief economist for Trulia. During the time it was bought by Zillow, and that was an interesting period. I worked as an economist at the California Association of Realtors, National Association of Realtors. I also worked at HUD. So I lived on the East Coast. I actually lived where you live for a while. I got my PhD at University of Maryland, College Park, and that's where I was at NAR at HUD. So my entire career actually has been as a housing economist. Sometimes it's scary for me to realize that, because that's the only thing I've ever done is housing economy. So that's where my experience comes from.
Wonderful. That's wonderful, Selma. So I would imagine that you spend a lot of your time thinking about obviously the housing, economy, and all the risks that are tied to it, right? So when you look at the economy right now with so much going on, what do you want actuaries to understand about the current economic environment? That's not so obvious from traditional forecasts. So, in other words, when you step back and look at the economy today, what feels different in ways that traditional forecasts may not be able to fully capture?
I mean, that's a great question. There's so much going on in the economy at the moment, and there's so many cross currents that have a varying impact on the economy. I would say that, we're in a much more complex environment than we've been in a long time. Pandemic, it was an unprecedented event. If you remember back in those days, the word unprecedented, you couldn't get away from that word because we were just facing shock by shock, day by day, all these shocks that we've never experienced before. But I think what is currently happening is that the economy is just so complex. We have this strong growth coming from AI investments and a lot of fears about what AI is going to do to the job market. And so there's so many anxieties and fragilities. And then on the flip side, you have, positive economic growth, which keeps surprising us quarter after quarter. But then at the same time, you have this segment of the economy, this, we call economy being a K-shaped right now, because you have a very strongly performing part of the economy and not so well performing part of the economy, the lower part of the K, right? Where we have folks that, are not necessarily doing that well. They did not see the increase in wealth or wealth gains from AI, from, home equity, from just all the accumulation, Bitcoin and the coin world, all the benefits from that. So they're not economically doing as well. So on the face of it, economy looks good. But again, as I said, there's so many fragilities and anxieties underneath that we have to really, be aware of. And then when it comes to housing too, housing is so bifurcated. We are talking about very stretched affordability. We're talking about mobility that has, frozen since, those peaks of the pandemic. We're talking about high cost of insurance, taxes, construction costs. So, while all of us are paying so much attention to the rates, it's not just about rates. It's about all these other things. So the monetary policy, so talking about, complexities in the economy, you have this monetary policy, and then you have this conflicting fiscal policy, right? A fiscal policy that's very stimulative, that it's really playing against the monetary policies. No, it's going to happen to the rates going forward. So It's just a lot of imbalances, I guess, that we have to, try to find a footing for to understand what's going on in the world around us.
Selma, you captured that really well. You brought everything together with the complexities of what's going on. Thank you. I
Mhm.
wanted to talk a little bit about AI, which is also causing a lot of complexities that we had not thought about. At the conference, I heard you talk about the surge in AI investment and sort of how valuations are beginning to look familiar now. For actuaries who are trained to worry about the tail risk, right? What parts of the AI boom sort of feel different from past tech cycles? And what are some similarities that you're seeing from the previous tech cycles that we've been through?
Yeah, I mean, that's a great question because I see and hear so much, on one hand, excitement about AI, right? The
Yes.
investment in AI is surging incredibly. And that was actually one of the charts that I showed at the conference. But then on the flip side, what does that mean for all of us? And do we end up in the same situation that we were during the dot-com boom? And so what feels very similar is that this whole thing about having AI in your name, like it was .com, in our data, we show, for example, that 200% increase in commercial leases in tech hubs for companies that have AI in their names. That's what resembles so much what happened during the dot-com frenzy. But what is genuinely different, I think, is the tangible productivity. AI optimization tool is now being plugged into existing profitable businesses. So it's not about businesses that we don't even know what they're going to do. It's about existing profitable businesses that are already in the works right now, and AI tools being built into the tasks of those, or, using the AI in the daily tasks that is making everybody more productive, right? And so to give you an example, like Cotality, for example, we're using AI to analyze property photos and listing descriptions, and that has cut our data processing time by some 40%. So, that is a real productivity gain. When we look at economic data, when we look at productivity gains, they have increased, they have sped up since we saw this influx of capital into AI investment. So productivity gains are real, but again, is it too much? It certainly does feel a little bit like a dot-com era in terms of just how much monies and how much maybe hype there is around AI.
Right. And that's the other thing that sometimes I think about. I'm curious to know, in your opinion, Selma, what would happen if this cycle was to turn, right? The AI cycle sort of flips, right? And where do you think the real economic pain would show up first if this AI boom that we are seeing sort of stalls and does a turnaround? Where would the pain show up?
Great question. I think firstly, I would see, imagine it would be in equities. Equity market would start coming down. And, as I mentioned earlier, the top part of the economy, in terms of the letter K, the more affluent consumers, those that benefit from those equity gains, they would have been actually the ones driving economic activity. When you look at the economic consumption in the US economy right now, and we know that some 70% of economic growth comes from spending from US consumers. If those affluent consumers stop spending because they don't see those wealth gains that they have seen from the equity market, you immediately start seeing less consumption. That impacts retailers, that impacts goods producers, that impacts luxury space as well, maybe travel. I mean, it has ripple effects through economy really, really quickly.
You also talked about tariffs and construction costs, right? They're pushing prices higher. And we've just found out that the Supreme Court has struck down tariffs on imports. So, what does all this mean, Selma? Can you bring it together? What does this mean for insurers when it comes to claims, replacement costs, future pricing? Can you just, bring this together?
Yeah, tariffs have been one of those horrifying words for a year now. And, we've all worried so much about what the impact is going to be, and especially how it feeds through in terms of the inflation pressures. And then again, what does that mean for the monetary policy? Like, there's so many effects that could have had, slowing economic growth, and so on and so forth. Now, tariffs, have not had persistent effect on inflation because they have not been implemented so consistently. One day we're on, one day we're off. Some segments of some goods have had tariffs put on them, some haven't, so it's been very inconsistent. That's why I think, economists early on said that tariffs are going to have a very negative impact on the economy if they were implemented at the level that, the president was talking about at the time, especially, if you think about the narrative back at the Liberation Day, last April. Well, we haven't seen that at that level, but we have seen impact on construction costs, because some of the inputs that go into the construction costs, particularly lumber, aluminum, appliances, a lot of appliances come from China, for example, we have seen the impact on construction costs. So construction inputs into material and components for construction have gone from 1% year over year increase in terms of the prices to 3%. So they have accelerated over the last 6 months because of tariffs put in place. So it is a real concern now. Now, as you mentioned, the most direct impact is on replacement costs. And in our data, we do see that the replacement costs have gone up significantly, especially since tariffs have been put in place. Now, how does that impact consumers and insurance companies? There are two things. One is that many consumers are now significantly underinsured because, the replacement costs have gone up so much, and they are insured under replacement costs of a couple of years ago. So that's creating a huge risk for both consumers and their carriers. And then we have this issue with premiums going up. They've gone up, 14% on average, say, or 14% in 2023, 14% in 2024, and then 10% 2025, and that's up from like 2 or 3% prior to the period before the pandemic. And not that pandemic had anything to do with it, but partially did. And so, premiums have gone up. And then, then you have this, again, ripple effects of all of this. What does this mean for escrow costs that existing homeowners have to think about for, their insurance and, separate issues, but property taxes? Now they have to put much more monies into their escrow account. And for homeowners that are in the lower part of the K economy, that are on fixed income or lower household spectrum of the income group, they are now facing significant financial hardships because these costs have gone up so much.
That makes sense because I really get the feeling, like we talked about this earlier also, that it's a complicated environment, and to bring it all together, it's just hard. So I think it's really helpful to have your insights and how you bring it all together for our audience. So thank you for that.
Let me take a moment to remind listeners that you're listening to Actuary Voices, the podcast from the American Academy of Actuaries. On this podcast, we talk to Academy volunteers and leaders, as well as friends of the Academy, about what excites them about their work, both professionally or as an Academy volunteer. Please visit our website, actuary.org, for professionalism papers about artificial intelligence and much more. And you may also subscribe to Actuary Voices on your preferred podcast platform. And now, back to Preeti's conversation with Selma Hepp, the Chief Economist for Cotality.
I'll go back a little bit, Selma, on the K-shaped economy. You've mentioned that a couple of times. Other economists also have been talking about it. We all know that some households are doing very well, others are struggling. That's why we have the K-shaped economy. So in terms of risk, especially when I'm thinking about actuaries, right? How does that unevenness change the way risk shows up? So whether it's credit risk, whether we are talking about housing repairs, you've talked about a little bit of that, underinsurance. So if you can just talk a little bit more about that, that'll be great.
Yeah. So, I think ultimately what changes when we have an economy like this K-shaped economy is it changes how we measure risk, right? It's not just a single aggregate number for an area, right? It's really household by household. It's home by home. It's not just a climate risk that actuaries need to worry about, but it's also now how do they measure risk? How do they measure household ability to pay that higher cost of insurance or higher property taxes? Or what if this segment of the population lives in a part of the economy where home prices are not appreciating as fast as they have, or not appreciating at the same rate that other parts of the country are appreciating. I mentioned earlier too how we have such a bifurcated housing market. So some parts of the housing market actually see home price declines. And so you have to take that into consideration, because, it's not just, again, about climate risk insurance. It's about equity gains or losses. And so people are now losing equity. So then they don't have that financial buffer that they have. And so they're more exposed to additional financial hardship if they lose a job. We generally know that when people lose a job and they don't have any equity in their home, those are two triggers that lead to a foreclosure historically. Now, things have changed during the pandemic, but historically. And so if you don't have equity in your home, you don't have that financial buffer, right? And so in this bifurcated economy, we now have to pay attention to what's happening to the household, as well as to the local housing market, as well as to availability of insurance or job market, or, things are so bifurcated that it really, again, changes how we measure risk.
That's absolutely right. So I also wanted to talk to you, Selma, a little bit about the modeling side of things. Just like economists like you, actuaries obviously also rely heavily on forecasting and pricing models, right? Whether that's for housing, you're talking of inflation, insurance losses, and all of that stuff. So, the economic environment is changing so much. It's changing so rapidly. So, how do you think about the limits of models when the economic environment is changing? I mean, how do you recognize that the assumptions no longer hold? Can you talk a little bit about that?
Yeah, that's a great question, and one that's sometimes difficult to reconcile. I would say that one thing that we are learning is that we can no longer rely on models. The biggest actually limit to models that we're looking at right now is that they're trained on the past, right? And then, we came to the pandemic, and pandemic was a structural break, and many correlations that we had before the pandemic no longer held during the pandemic, right? So this link that I was talking about of unemployment and mortgage defaults, they used to be rock solid before the pandemic, right? You knew that when you see a rise in unemployment, you also saw increase in mortgage defaults. And then what happened during the pandemic is, there was all these government programs put in place, such as forbearance programs, for example, that allowed people to stay in their home, extend their mortgages. There was a number of ways in which people were, ensured that they don't end up homeless, essentially, or lose their home. So, now when we think about models, we can't think about just what happened in the past. We can't just rely on the past. When somebody asks me, what is historical home price appreciation? When you look at the historical trend line of home price appreciation, it's all over the place, right? It's up and down. And so what you end up doing is you just draw an average line, and that's sort of a reconciliation. You're like, I don't know, but this is the average long-term line. So, it's about recognizing that, maybe that average line is just a baseline off of which you work, but, there's going to be so much volatility along the way.
That's a great way to put it. So I'll go back to where you started, Selma, which was when you joined Cotality. The pandemic had just about started, right? So this question sort of ties in with the forecasting and, any lessons learned. So looking back at your career, what's one forecasting lesson that you've sort of learned the hard way? And I don't know why I keep thinking that maybe the pandemic, there was some things that you learned about forecasting and modeling at that time. So if you wanted to talk about that, that'll be quite interesting to our audience.
I think, one thing I guess I realized about forecasting is like, it's not a one and done deal. And I guess, naively, I used to think, you forecast a number and that's it. And then I heard somebody say, we are so good at forecasting that we update our forecast every month. And that was more of a reality. Like, forecast is a moving target, right?
Right.
And so you update it weekly, you update it monthly, you update it based on new data that comes in. So it's not one and done, and averages, again, average is a lie. As I mentioned, that volatility we see along the way, that was the biggest learning lesson, is that, a forecast is a moving target. One thing about Cotality that's been super interesting to me, and it really, I'm so grateful to be part of it, is we have so many data points, right? And so the more data points you put into a model, obviously you hope that it's a better model, but it's also about how data points evolve, and so, with every new data release, you get a better read on what's happening out there. And so this is where that target keeps moving, because every new data point gives you something new to think about, about how, what your outlook actually is.
Well, Selma, thank you so much. This was such a great conversation. So, I did want to ask you a couple of last questions. So, we typically end every episode with our guests answering a question left by our previous guest. And then you get to leave a question for our next guest. So, our last guest asked you, what's the easiest way to explain to the public what actuaries do?
Yeah, so I actually must be honest, I had to look this up because I didn't know how to describe this in easiest way possible. So, I was digging around, and what I found that I could relate most with is that actuaries are like fortune tellers, but instead of using a crystal ball, they use math and they use data. And I guess economists do the same thing, but I think actuaries are more long-term thinking.
Yes.
And you know how you go to a fortune teller and you want a direction in your life that maybe is not about tomorrow, it's not about next year, but it's like, okay, this is a direction in which you can think long term. That's sort of what I would think about when I think about actuaries.
That's a great way to explain to the public what actuaries do. Very easy. Now it's your turn, Selma. What question would you like to leave for our next guest? It could be about anything personal, professional, broad topic, whatever. What can we ask our next guest?
Yeah, so I was talking a lot about short-term data and real-time analytics. Especially you were asking me, what changed in my perspective during the pandemic, and I think what came to light is the importance of real-time analytics. Remember, this was a period during which we were all looking for day-to-day data. What's happening day to day, because things were so unprecedented. We didn't know how to react to the reality that was around us. So, giving this increased focus on short-term data and real-time analytics, I would say, what is the enduring value of long-term thinking that the actuaries do? How do you protect that perspective in your own work of long-term thinking?
That's a great question, and I can't wait to hear the answer to that question, and we'll be sure to share it with you as well, really. So, once again, thank you so much for joining us. Before we end, I would like to leave our audience with one last nugget of information. So, what is the single most important economic risk or trend actuaries should be paying attention to right now?
Goodness, I don't know if there is one risk. When I think about developing scenarios at the moment, there are a few things that can impact that. One is the AI. I mean, it is risk in many ways, in real risk, because people worry about their jobs. Like, I now more and more think about how AI is going to affect my job 10 years from now when I am going to retire, right? But then there is the risk of, what the administration is going to do. We have a different type of administration than we're used to. We also have a lot more geopolitical risks, and we have environment in which international relations are changing, from long history of the ways in which we did things before. So, I think there are a number of risks out there, but I think these are some of the risks that I think about almost daily right now.
I completely understand. So, thank you so much, Selma, for this wonderful conversation. It was just great to have you.
Thank you so much for having me. It was such a pleasure to talk to you as well.
You've been listening to Actuary Voices, the podcast from the American Academy of Actuaries, where Preeti Vasishtha was in conversation with Selma Hepp, the chief economist for Cotality. Please visit our website actuary.org for a wealth of information about the work that the Academy does. You can follow us on Facebook, X, and LinkedIn as well. And of course, please subscribe to this podcast on your preferred podcast platform.